Investment features, methods, and structures. So, what are features, right? Definitely, they are different from traditional investments. So, what we're going to start off with is how are alternative investments different from your traditional investments in terms of their features. Then we will move on to talk about what are the methods for an investor to be able to invest in these alternative investments. And if they're going through a fund manager, then what are the compensation structures that can be in place for the fund manager to share in the returns? Right. So, what did we say? Features of alternative investments, and we'll be looking at features category wise. Then we'll get into the different methods of investing in alternative investments. We'll talk about the advantages and disadvantages of each method. And then finally, we'll get into compensation structures that are used in alternative investments. Let's get started. So, first of all, what are traditional investments? Long only position in stocks, bonds, and cash. So, if you're buying stocks, or bonds, or you're buying currencies and just keeping them, that is a traditional investment, right? But for example, if you go long short equity, which means you buy some and you short sell some, then that is not a traditional investment. It is going to be a type of alternative investment. Specifically, this is a hedge fund strategy. There are other types of hedge fund strategies, but this is one of the examples of a hedge fund strategy, which is long short equity. So buying long only stocks, that is traditional investment. But if you go long short, well, that's not traditional. It's going to be alternative. Similarly, stocks, as you know, are publicly listed, right? But if you're investing in private capital, that is not public. So bonds are publicly listed, stocks are publicly listed sources of capital. Bonds are, of course, debt, stocks are equity. But if you're investing in a private company's debt or a private company's equity, which we call private equity, that is an example of alternative investment. And of course, real assets such as real estate and so many others. So we're going to be getting into the breakup of what is inside private capital, what is inside real assets, and what is inside hedge funds. But first, I want you to internalize the difference between traditional investments and alternative investments. So traditional investments are your long only cash, stocks, or bonds. And alternative investments can be divided into three main categories: private capital, real assets, and hedge funds. Right, so let us get into the features of alternative investments. Now, why is this an area of interest? And it is a growing area of interest. Since the mid 90s, it has been significantly growing and continues to do so. Now, number one benefit, diversification. And take that with a pinch of salt. What I mean is that it's not always true, right? So, in times of crisis, especially for hedge funds, in times of crisis, that diversification benefit is not really there, especially for hedge funds, because they even crash, right? When everything else crashes, like your stocks, bonds, it's kind of bad news for hedge funds as well. It wasn't always like this, but recently what we have been seeing more and more is that this diversification benefit is not really there for hedge funds in times of crisis, but private capital and your real assets still offer certain benefits, right? But overall, apart from the diversification benefit, overall alternative investments does offer better returns. And there is a reason for that. The reason is that they have liquidity issues. So in terms of liquidity, which means being able to convert your position into cash without losing much money. So if you think about stocks, let's say you have a position in an Apple stock, right, versus you have a private company, so a private capital investment, which is shares of a private company. What do you think is easier to convert to cash? Obviously, the Apple shares, right? The public listed traditional investment. So, because these alternative investments, they or a real estate, for example, so real asset or a hedge fund investment, they have a lot less liquidity, more difficult to convert into cash without losing much value. So therefore, because of the higher risk, there's higher returns. Now, coming back to the diversification point, that yes, usually there is a low correlation between traditional assets and your alternative investments, with the exception of hedge funds during crisis. Otherwise, real estate, private capital can give you good yields, right? In periods of low interest rate, and even more importantly, even during stressful periods, it can be very, very useful to have these alternative investments. Now think about it. If you have rental yield coming in from some real estate, right, and or if you have, let's say, private capital investments where you're getting salaries yourself because you're working in that business, or you're being able to pay yourself dividends when you need it because you're on the board, you're controlling that company, versus having investment in public stocks. And in times of crisis, let's say the market crashes, at least with the private capital or the real estate, you still have an income going on, right? So it does definitely give you that diversification benefit. And because it is less liquid, it gives you higher returns as well and higher yields as well. Right. But of course, it's easier said than done. It's very different from traditional investment in various ways, right? Of course, there are a lot of similarities as well, because mostly we're talking about investments here. So private capital will have a lot of similarity with public capital in terms of that they are both equity and debt, right? Real estate is also, you're going to be looking at it from an investment perspective. Your hedge funds are also going to have a lot of similarity in terms of the underlying assets that they will be dealing in. So they deal in stocks, bonds, currencies. So again, that is your same building blocks that you use in traditional investments. But clearly the strategies are much more complicated, right? So there is a need for specialized knowledge. For instance, if we talk about private capital, and within private capital, you have debt and equity. So if we specifically talk about private equity, either you can go for startups, which is venture capital, or you can go for buying very, very large, mature companies with stable cash flows and using a lot of debt to buy them out, which is leveraged buyout. This is not something that anybody can just get up and do. It requires very specialized knowledge and skills to be able to do that, right? People who specialize in startups are very different, and people who specialize in buying mature companies using a lot of debt and turning them around is a completely different skill set, right? Compared to buying stocks in the public market. And because of that, what happens is that the fees is also substantial that is charged by the managers who focus in this specialized area. As already discussed, the diversification benefit is there, right? So it does have a low correlation with traditional traditional investments. However, as stated already, that the correlation may increase during times of financial crisis, and this is mostly true for hedge funds, especially. Alternative investments are relatively illiquid compared to your traditional investments. Therefore, you need a long-term investment horizon and a large amount of money. You can't just go about buying real estate for a day, right? It's going to be a longer term perspective, and it's going to be a relatively larger amount than just buying some public stocks or bonds. Now, what are the features of alternative investments? So, there are different types of structures that we can use, right? And I'm not talking about compensation structures, it's about how to get that exposure. And then we will link it to the compensation structures as well. But the first thing you have to understand is that nobody can stop you from buying a real estate yourself, right? You don't have to go through a fund that buys lots of different real estates and gives you that diversified exposure. You can very well go and buy it yourself, or you can very well start a business yourself or invest in the private capital of a business. But then, because it requires a specialized skill, you might want to go through the specialists or managers. And then clearly, if they are specialists, then the information that they will have is not going to be the same amount of information that you will have. So it's not going to be equal, it's not going to be symmetric, it's going to be asymmetric. So there is an information asymmetry between you and the manager, and therefore you will have to pay the manager for their services. And this is a bit tricky because you might not know exactly what they're doing. So you have to be very, very careful in this space. And that's where the performance appraisal challenge comes in, because, I mean, if you don't know what they're doing, how are you going to appraise their performance? So this is one of the tricky areas within this space. Now, let's take a break here. We'll come back and then we'll get into the details of each of these categories.